Good afternoon, Crystal.
Hello, how are you, Javon?
I am great. I've got our banner going. I am great. It is a good day to be me, and I'm super excited to talk about our topic. We're doing the deep dive on those 5 things that I said you need to do in order to profit from a downturn economy inside your 401k plan. So,
Mm-hmm.
super jazzed about doing that. So, how about I read your bio and then we'll kick it off?
All
Sound
right,
good?
sounds good. Mm-hmm.
Hello, everyone. Please welcome my friend and colleague, Crystal Mitchell. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions, the co director of Recycling Black Dollars. She's also the co host of The Business Zone, that other broadcast with my, my friend Gilbert. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. How you doing, Crystal?
I am well, and yourself?
Fine as frogs hair.
Fine as frog's hair. Okie
Yes.
dokie.
Yeah, ready to get to it. Okay,
Oh.
so without too much ado, last week we talked about the 5 ways to, or 5 of the ways to manage your 401k in a down market.
Mm-hmm.
And the first one was, of course, increase your contributions, because as a long-term investor, and I think that actually should have been the first one, is to change your mind to recognize what long-term investing is. And in the world of the 401k, the qualified retirement plan, the long-term investor is the person that is going to be investing for, let's say, a long time. And for some people, that's different. For most of us, that's 5 to 7 years minimum. That's what it
Mm.
is. It's called a long-term investor. Um, so it's someone who's going to be in the market for a considerable amount of time, and they're going to take advantage of market downturns.
Mm.
So that's very important, because most people think of themselves as a long-term investor and they stop at being in the market for a long time. But as you may have heard me say, we as Americans, even though we've retired, many of us are going to still be in the market. Many of us need to have a portfolio that is going to be able to have some risk and is going to be able to grow even though we're not working. And that's kind of tough, because most Americans like the idea of having that stability in their life, like that money is always going to be there. Well, when you're taking money out, sometimes you're going to hope that it grows. So if you're taking 3 or 4% out, it's nice that you're getting an average return of 7 or 8%. So that money is always there. That's kind of where we are. For most of us, we didn't start saving enough, and we didn't take enough risk. So we don't have the luxury of having this pot that we can just pull money out of without putting that pot at risk. So for many of us, even though we'll be retired, we're still long-term investors, because we're not going to die. We don't have the good sense to die at 65 when we retire at 65. Right? So okay, so that's the long-term thing. So number one, that's what I think first is, let's consider ourselves long-term investing. That's the way that I was taught. That's the experience I have. That's the way to make money. The short money game is tough. It's really tough, and it's not something we can talk about here. It's out
Mm-hmm.
there. Trust me. There are lots of people that are making millions in the market, and there are lots of people out there making hundreds of thousands in their 401k plan, and they're seeing an opportunity and they're jumping on it, and they know a lot more than I do.
Yeah.
That's just it. That's just the way it goes. So, how can us regular folks take advantage of this down market? Number one, like I said, let's change our thinking to long-term thinking. We're investing long-term, and we're going to take advantage of market downturns. Not be afraid, but take advantage. Number two, the first thing most of us have to do is get a budget. We have to get a budget. We have to see where we are, to see how much more we can put in, And if we don't do a budget, we're kind of stuck. Now, there's a lot of folks out there that I say to me, because they've said to me face to face, my budget is paying the bills, right? If I can get through the month and still go out to dinner, I'm good. The budget is tough. And, it can be. I was talking with my niece and we did a budget for her. She was smart enough to say, Unc, I need you to help me do my budget.
Mm-hmm.
And I let her know that, there's so many wonderful programs out there to help someone with the budget. I remember the days, and I still just do the Excel spreadsheet. That's me. I'm old school.
Mm-hmm.
But there's a lot of help out there, right? But I think the problem that most people have when it comes to having a budget is they figure out, or they get this idea that they're going to have money. You ever talk to folks like that? They're like, oh, I'm going to do the budget, so I'm going to find money. You ever talk to folks like that?
Yeah, there's currently one in the White House that says he's going to go find money. You led me right into that. Well, here's the thing with budgets. One, they're not etched in stone because there's so many external challenges or external things that can adjust that you will be forced to adjust that budget because we're not in control of things like our utilities. We have no control when they do a rate increase. We have no control when food increases drastically due to tariffs. We have no control
Due to what? Due to what? What'd you say? Due to tariffs?
Due to tariffs. We have no control over those. We can control what's in our house, but if you got to bring something in, obviously, unless you're doing all your growing of your own food, then you're controlling that, right? But you still are buying soil and stuff to maintain that. So, unfortunately, yes, we all need to have a budget and a guideline, and at least have it in your head, how much I'm spending, and know how much money is coming in and out every month. But also know that there are a whole lot of external um, uh, things that we can't control that govern how we spend our money.
Most definitely. I could not agree with you more. And I really like the idea. I really like rather the point you made. There's so many things that we can't control, right?
Mm-hmm.
Stuff is going to happen. And that's why we need to have the budget, because it gives us an opportunity to say, yeah, that's okay, or B, that's not in the budget, or C, we need to reevaluate our budget.
Mm-hmm.
Yes. And I said to my niece, it should take you a couple of months to iron out your budget. So don't think that when you go to the program or you do the Excel sheet or whatever it is that you do, don't think that the first time you do it, you put all those numbers down, that you're going to have the budget that you want to have. Number one, people don't remember what they spend their money on, right? So it takes a little bit of practice to do that, right? So it might take you 2, maybe 3 months to figure out what your real budget is. That's okay. We're going to be in this type of economy for a long time. So take those 2 to 3 months and get that control. So number one, long term, and number two, budget. Do that.
Mm-hmm.
The other thing that I like to tell folks is make sure you put in the budget the emergency fund. And we used to not talk about the emergency fund very much, because we'd say to people, look, allocate all your money, and if you've got something left over, put that in your 401k, or put that in your IRA, or buy a policy. But I'm a huge believer of the emergency fund, because the emergency fund frees you up from worrying about blowing up your budget. So many times I talk with people and I say, okay, is this in your budget? And A, they don't know. They're like, I don't have a budget. I just spend money. Or B, I've got to move some things around. Okay, that makes sense, right?
Mm-hmm.
But with an emergency fund, if you know that you can survive the next 4 months or 5 months, and again, if it takes you 4 or 5 years to get to your emergency fund total, if that's the deal,
Mm-hmm.
it's fine. And Rome wasn't built in a day. So um, get that emergency fund so that you can have peace, so that you don't have to worry about your budget being blown up. And if something happens, you got some money. That's what it's for. It's not there to just sort of sit on the shelf and wait till you lose your job. Your emergency fund is there so that if something happens, you don't have to take money out of your retirement. You don't have to take money out of your grocery list. You don't have to take money out of your whatever it is, right? And and trust me, this is so weird, but trust me, starting the emergency fund at the modest means that you can, just starting it starts to give you peace. It starts to give you uh, you start to relax just a little bit, even though you know that you've got a ways to go. Uh, it's just a great thing to do, the emergency fund. And the last thing that I'm going to say with regard to taking advantage of a down market
Mm-hmm.
is, uh, and my one of my favorite advisors, Brian, I think his name was Brian Walsh. He said, "Make sure your insurance is right." That's kind of
Mm-hmm.
a weird thing for someone like me to say, but Brian was an investment advisor. People would come to him to set up their portfolio so that they could, you know, save for their retirement and what have you. And he would say, that family that you have is extremely important. And the last thing you want is for you, whatever spouse you are, or not spouse, if you're doing this all by yourself, is to leave those people in a lurch. So before you invest your money, take a look at that insurance. Take a look at, are these people taken care of? That's so important because as we start to invest, we could lose it all. Job could be gone, get hit by a car or a bus as we're walking down the road. I used to say to my friends, you know, who were healthy, that they were going to get hit by a bus when they told me I needed to lose weight and stop drinking and smoking. So, based
Oh
on
my.
that,
Okie dokie. uh, well, I
team
mean, we
writer,
if we want a shining example is a month, or it's actually a month and 3 days this year. Many people on every level of economics, socioeconomics, lost their homes,
yeah,
and um, and most people's portfolio, or you look at their balance sheet, which is giving you their net worth, the larger portion of that is the property they live in.
yes,
And so when you lose your home, yes, you on paper you look really good. You may be worth 4 or 5 million, $10 million, but if your home is 9 million of that, then and you lose that home, then there's your net worth has shrunk drastically. So when we look at those individuals that in Palisades as well as in Eaton,
hmm,
in Al Tadena, a lot of
yeah,
those people lost their homes, and more so in Palisades, which was surprising, but not so much, but it was. Their insurance, their homes were much more valuable in the current marketplace than the policies that their insurance policies they had. So they were grossly underinsured.
yes,
And we tell everyone, always go back to your insurance and review it every year, because in the marketplace, when predominantly your assets are your home, then that's increasing steadily, especially in the state of California. Actually, I think all over the United States right now. And so a lot of those people, all their homes will not be insured, and nor will they be replaced at that price. And then some of them don't have. People tend to go with the cheaper insurance, not thinking that anything's going to ever happen, right?
right,
Um, but it does happen, and things does happen. And so if we want to take that as an example, and then if we want to take the pandemic as the other example of the emergency fund, uh, some people survived because they had an emergency fund, especially
Right.
those that were not eligible for all of the monies that were being floated out there with the CARES Act. And we are in a new um, administration, that a lot of the guardrails and the things that we relied on during that pandemic or crisis will not be there in this next 4 years.
I
So
think you're speaking a lot of truth. Oh, I'm sorry. I didn't mean to
no,
interrupt you.
no. So we gotta restructure or rethink the norm, because the norm is not the norm anymore. And so if we want to protect ourselves, then we cannot assume that the federal government is going to be there to bail us out in the event something takes place um, in the next 4 years. And so you almost, as my girlfriend says, she's from Cuba, and her father, they lived through Castro regime and the takeover of Castro regime. They took all of his property, but the only saving grace when they migrated to the United States was he had kept money in a cigar box under his bed, and he had
Mm.
been putting money in that for like 20, 30 years, because he never knew and then of course he adopted those same principles when he came here, because he had experienced it, so he was able to get out with his money. So we really have to kind of change how we think nowadays, because it's not going to be like it used to be.
Yeah, we can't go back, right? It's not going to
Mm-mm,
be the way it used to be. And
mm-mm.
I'm certainly not advocating that people put things in their mattress. Of course, in that Palisades fire, that was
It
not a
would
very
burn.
cool place.
Wanted
But
to save the deposit box.
yes, exactly, right. The safe or something like that. The thought is very, very much on point, and that is we don't know what's going to happen. And there are lots of people in the country that are suggesting that we never were supposed to be a country where we had guardrails. Depending on how you believe, which way or the other. Even if we are a country that does have guardrails for the citizens, I can bet you that the guardrails are not going to be. They're not going to be what you want, right? They're not going to be the way that you like them.
No.
So it is very, very important to set up that emergency fund and and make sure you have the proper insurance, and then have that long-term time horizon and mindset for how you're going to uh, take advantage of the down market. Um,
Mm-hmm.
and if I could do a quick little, I love that portion of our broadcast where we talk about don't be that guy. And so
Mm-hmm.
the quick don't be that guy this time, I'm going to jump ship a little bit, and I'm going to say, don't be that guy, guy or gal, couple that um, doesn't plan for your kids to go to college,
Mm.
right? Don't be that person. Um, you know, we can get into familial dynamics and all of that kind of thing. And that always throws everything asunder when
Mm-hmm.
family
Mm-hmm.
dynamics get involved. But I'm going to say that when we're looking at setting up our finances for the home and you welcome that new life into the home, start then with regard to saving for that person's education. And you can do it in various ways. Some people do it through a Roth IRA. Some people do it through a college education plan. Some people just start a life insurance policy. I, for one, am not here to tell you how to do that on this show, right?
Mm-hmm.
But you can talk with your financial advisor, your 401k person, and Dollars to Donuts, they've got a plan for you. There are so many ways to go about. So I'm going to say right here and now, if we really want to take advantage of this this down market, take advantage of this
Mm-hmm.
down market, we want to make sure that we don't be that guy that didn't plan for their kids to go to college. And
Mm.
I'll tell you why that is. It's because of those types of things where we're not able to plan for that college or that education or that first house or what have you, right?
Right.
We can plan for that. And those are things that help create what we call the sandwich generation, where you have to take care of the kids and take care of the parents in your prime earning years, and there's just not enough money to go along. And so now we're really having that discussion about the budget. So
Mm.
the idea, let's break that cycle, right? Let's get out of one of those situations. It might take a couple generations. And I'm going to say, before I let you have the last word, I'm going to say, have this conversation with your kids. Somehow figure out a way to not ruin their childhood, but make them aware that they really need to be responsible for themselves. And what you're doing is trying to provide for them. And you may not succeed, but give that lesson in there. Start putting
Right.
money into that 401k plan with that long-term mindset. Start that emergency fund. Start that insurance. Let your kid and your spouse know all about that plan.
Yeah.
That was a wee
No,
bit
no.
emphatic. I apologize, but that's I think my colleagues and I, those of us that work in retirement plans and those of us that work at as financial planners, we would really like to talk to folks that have saved for their kids' college, have an emergency fund, and have a long-term point of view. It makes your dreams so much easier to happen.
Right. And I also think, so the college piece, yes, definitely saving. Yeah, your child may not go to a traditional 4-year college, but they may want to go to a trade school, or they may want to go to nursing school, or whatever that is. You have the money, right? So you're saving for the future of your child, for whatever their aspirations are. So I think sometimes people get kind of, you know, thrown off with the college piece, right? Well, maybe my kid doesn't want to go to college. Well, but that's not what it's about. And if your kid, I don't know, starts his own business, there you can invest in their business from that college fund. Or if that child, whatever that is, right, wants to live abroad for, a year or two before they do, you have the funds for that. So it's whatever your child's aspirations are, but being prepared is so much better than, oh my God, it's here, and now we got to hurry up and scramble, and we got to do this, we got to do this, we got to do this, and again, we're living in a different era. You got to money's got to be coming from all sort of resources right now.
It's so true. At one time I was doing um, not benefits, but I was hosting happy hours for HR people. And every now and then, one of my colleagues would come and he would give a presentation. And he happened to be a motivational speaker, change expert. His name's uh, Chris King. He's a great guy. Um, and every time Chris said something, it was just something that just made you think. It was just a head
Mm,
turner. And one of the things I remember him saying was that at the way that progress, and I'm paraphrasing now, the way that
mm-hmm.
progress is moving, it's very possible that the job that these HR people are hiring for right now today won't exist 10 years from now.
Mm-hmm. That's true.
So, and I think he was making a comment on a couple of things. Number one, the world is changing, and then number two, the world's changing fast, and it's
Mm-hmm.
changing quicker and quicker. So, when we take a look at what are the options for your child when they finally get old enough to leave, they're going to be dramatically different, perhaps, than the ones that we have now. So, how do you prepare that? Start
Right.
saving anyway, right?
Right.
Just start putting a little bit away, because a little bit is worth a lot over time, right?
Yeah.
And you said if the child doesn't go to college, you can still access that money. Maybe you have to pay taxes, maybe you have to do whatever you have to do, but start saving. And if you decide that saving for college isn't the right thing because you don't really believe in college, okay, what about that trade thing, or what about that travel to Europe, or what about that business, or what about that first home? helping that person get into that first home. Now, here, it's tough to buy a house in Southern California that's less than $800,000
Mm-hmm.
that you want to live in,
Mm-hmm.
right?
Mm-hmm.
It's tough. And so if you were able to give your child 20, 30, $40,000 as a down payment,
Mm-hmm.
or $20,000 to help them with their payment,
Mm-hmm.
right, the first year or what have you, that that grows pretty far. So I'm just gonna reiterate: number one, get that long-term point of view, right? And that means in the market for a long time and take advantage of market downturns.
Mm-hmm.
I just have to put in one little piece here, and that is some of you are probably going to say to me, because many of you have, that you're missing out on opportunities while you're learning how to do this. And a, that's like saying to a toddler that you're losing the race from the sprinter because you don't know how to walk yet. You gotta learn. You gotta learn your deal, right? And you'll get there. You'll get there.
Yeah.
There will always be opportunities. There will always be races. So don't worry about what you're missing out on. But long term point of view, and I'm gonna say, get a budget. And if it takes you 2 or 3 months to get a budget, good. That means it's a good budget. That's to that. And put in your budget, please put in your budget your insurance review and how that's supposed to work. And please put in your budget an emergency fund. And plan on all of that taking some time, but just have a plan to get there. Just get there slowly. This is a, how do they say it? A marathon, not
It's
a,
not a sprint.
yeah. Well, so I should let you get the last word. So how about this? I will read your bio again, and then
All
you
righty.
can give us the last word according to Crystal Mitchell. How's that?
All right. Sounds fantastic.
Okay. Hello, everybody. You've been listening to me, Javon Thomas. I'm a licensed retirement plan advisor, and Crystal Mitchell, who is a business coach and consultant. She's the CEO of Mitchell Business Solutions. She's the co-director of Recycling Black Dollars, co-host of The Business Zone with Crystal and Gilbert, another weekly online radio show. She's also an instructor at Mount San Antonio Community College, along with being a certified network for teaching entrepreneurship instructor, and last but not least, a QuickBooks Pro Advisor financial strategist. Crystal, take us out
Yeah.
with the last word.
Okay. So yes, everything Javon said is right, spot on. And more so than ever, I think, because we're just in a very volatile place in the world right now, and so you want to make sure you have everything that you need, that you can take care of your family, and you don't have to stress out if some uh, um, catastrophic event takes place in your life. So we've had some lessons that we were supposed to have learned in 2020, and we didn't. And so, therefore, we're being it's being reintroduced to us, and we have an opportunity to make it right this time. so, so let's learn the lesson. Let's not be the remedial child. Let's be the star student, and let's learn that lesson this time, so all the rest of us don't have to learn it again. For those that did it, so just make sure that the world is different. It's different than it was with your parents, your grandparents. It's a lot more complex than it used to be. So that means that we have to up our game a little bit and be just as complex, but definitely to be prepared. Most importantly, to be prepared.
You gotta love it. Up our game. Okay. We will see you folks next time on Conversations on the Patio. Thank you, Crystal, for joining me, and we'll see you next week.
All right. Bye bye, everyone. Have a great one. Happy Valentine's Day.
Yeah, indeed.